Hello, I kind of hate to be right about this one because I didn't make a video about Netflix a month ago, and I mentioned that I wouldn't buy the stock, and I explained why. Part of it was had to do a lot with amortization and the cost, the insane costs that Netflix has, and its lack of free cash flow in the very end. And so when this happens, you tend to get overvalued stocks. And when you have overvalued stocks, the problem with that is that the slightest fail in the company strategy, like some sort of guidance fail or some sort of a subscribers growth fail, as in Netflix case, can just wreak havoc and just completely tear the stock apart in the company. And right now you can see that after market Netflix is 20% down. And does it make sense? I mean, is that normal to happen? Let's take a look. Let's take a look at this article here. Netflix shares fall 20% on slowing subscriber growth. And you may be asking yourself, like, does that really make sense? I mean, okay, there is a little bit of slowing in subscriber growth, as you will see, but 20%, doesn't that seem too much? Well, there is a reason for that, and I'm going to explain. Now, let's take a little bit of a closer look first. You'll see here that here are the key numbers. Earnings per share went down a lot, and I kind of expected that, and I did mention that in my previous video as well. And this is something that I expected because of the pandemic. Because when the pandemic happened and it was like on its rise, you would expect that a lot of people would be watching Netflix, but as we're getting back to normal, this kind of number will eventually dissipate, and you won't be expecting so many people to keep watching Netflix and paying for it as in the previous couple of years or so, due to the pandemic again. And so earnings per share declined, and revenue is basically what they expected, which is good. It seems like the product is still useful to people, and you would expect that because Netflix is an amazing service. Problem is competition. And global paid net subscriber additions, a little bit actually more than expected. So that's good. But the problem, and this is why there was a fall actually. The company said it expects to add 2.5 million subscribers, and analysts expected 3.98, which is almost double than what than what Netflix expects to add. Now, it doesn't mean that it will be 2.5; it could be 3 million. However, the price of the stock gets affected because of this kind of guidance, because this is guidance for the next quarter. It's sort of like a projection for growth. And so when investors see that, they're like, okay, I don't really like that, especially with this kind of environment where there are so many new streaming services. Your stock may not be so appealing as it used to be. And this is why you're seeing 20% downfalls. Now, 20% is excessive, but there is a reason for that. And this is what happens when we're talking about overvalued stocks. And as I mentioned again in my previous video, Netflix is overvalued. I mean, you may not like that. You may think that Netflix is an amazing service, and I agree. Netflix is amazing. I have Netflix myself, and I've been having that for a few years already, and I love it. The problem is that the actual service, when you compare it to the stock, is a completely different thing. Like you don't have to mix, and you shouldn't really mix the service with the stock and the company and the financials of the company. These are completely two different things. I love Tesla, but I wouldn't invest in Tesla in its current price, because there is always a price for things. Things can be expensive, things can be cheap. You have to find the right price as an investor. That's the whole point of investing. And over here, you will notice that the current PE of Netflix, is at 46 almost, and basically staying about the same in the next 12 months. So there won't be much of a change over here. And what's even worse, if you take a look at the financials over here, and let me take a look at the cash flow, which again I have done in the previous video, and let me actually project it to take it back to 2017 to 2022, just have the last few years. And take a look at the free cash flow here. You will see that the company was actually losing a lot of money for many, many years, 2017, 2018, 2019, losing a lot of money. And 2020 they made money because what? Because of the pandemic. That's the whole point. And look at that, the last 12 months, 151 million compared to 2 billion. So they're basically going back to negative cash flow pretty soon, I'm sure. I'm sure. So I'm actually very worried about the current stock price and the current stock price level for Netflix. I think it has potential to actually go even lower when people actually understand what's happening with this kind of cash flow, because the company is not really making money if you exclude this past 2 years when they actually made money because of the pandemic. And the most important reason for that is amortization. Why? Because Netflix pays a lot of money to produce movies and films and series that you enjoy, and they're awesome. I'm actually watching a lot of them lately, and I love it. I mean, their productions are amazing. I mean, they are a lot of fun, and I still think that I will be a subscriber of Netflix because it's an amazing service. The problem is that there is such competition, such insane competition in this space from Disney, HBO, and all those streaming services, that it's gonna be tough to sustain this kind of growth, and also gonna be tough to sustain making money out of this. Because I mean, okay, you can make revenue, but are you actually banking anything? Because these kinds of movies and series cost a lot of $1 million. Like, that's a lot of money. And so you're amortizing this cost, because when you're actually buying, let's say, creating a movie, you're typically spending this money in a 4 year period. When we're talking about the balance sheet of the company, this is an amortized expense, so it shows in like 4 different kind of years, and you're getting sort of like a 25% expense every year. This is how it works for amortization, because amortization is some sort of a depreciation for a movie. Think about it like this, because movies depreciate as well. I mean, at some point they become irrelevant, and that's the whole point of it. This expense gets amortized over a 4 year period, typically. And this is what happens with Netflix as well. They're using a 4 year amortization period. And so their expenses are insane. And you will see here in their balance sheet, for instance, that their total equity seems to be increasing, yes. But still, I mean, you know, they have a lot of insane expenses because of this, because of the creation of new movies and all that. And you cannot really be sure what's going to happen with Netflix the next day, because there's extra competition. They probably will have to spend more money to make even more and better productions, with all this competition coming up. And I don't know how sustainable that is. I mean, this is something that I can't really project, but frankly, myself, I'm not a big fan of investing in these kinds of companies that have deep depreciation and amortization expenses. It's very important. It's These are the companies that EBITDA is something that you should never look at, really. There's a lot of expenses if you exclude the EBITDA formulas. And you will see here again that the total debt to equity is more than 100% as well. So, I wouldn't expect Netflix to go bankrupt anytime soon. But still, I mean, I don't want companies that are so much into debt, although they are doing a little bit better in the past few years. Now that it's the pandemic that helped a lot with the cash flow, and you can understand that. But overall, I mean, this kind of growth, I don't expect that it will be continued again because of competition. And you will see that, and you can see here that it's been going down and down and down and down in terms of growth over here of revenue. So they're selling less product than what they used to sell, and that's not great. And so things are getting a little bit suspicious over the years. And let's take a look at the cash flow again. I mean, the free cash flow here is the most important thing, and it's decreasing, and I don't like that. So the other thing over here that I want to take a look at is, let me go back over here, take a look at the outstanding shares. So they are diluting investors. You see here a lot of dilution, a lot of adding of new stock instead of getting debt. So things are looking sketchy, and I'm not a fan. So would I actually even think about entering Netflix right now at its current levels? Now, I think there may be a potential reversal at some point, and you could see Netflix going from 350, for example, to 600 again. It doesn't matter to me. I mean, this is all noise, because I don't just invest because there is hype. I mean, I do have some sort of like investments, if you can call those, for hype, but I don't call those investments myself. I call those more like lottery tickets frankly. But if we're talking about investments for the long run, this is not an investment for the long run. It doesn't make sense. There's no free cash flow. I mean, revenue keeps decreasing. Why would you invest in that? Like, I'm not sure. So again, I understand that you think that the company is great, and I agree, and you love the hype and all that, and you can make money out of hype, but that's not the way to long term invest. I mean, you can be fine and make money out of it, but it's gonna be mostly because of hype and because people talk about the stock and people buy the stock for no reason. And would you want to be part of that? You may want to be. I mean, it's a great stock for trading, but investing is a whole different beast. And if you're looking at holding this stock for 10 years, it's gonna be sketchy. I wouldn't do that for a company like Netflix right now, based on the current financial data that I'm looking at, because that's what matters in the very end. And I'm not gonna just hype up stocks in this channel just to gain subscribers. That's not my goal. I want to help you with investing. That's what I'm doing here. I'm not just hyping up stuff just because you will keep visiting the channel. I'm being truthful. I'm saying what I mean, what I feel, and what I see out of the financials, and nothing else. So you may not like that, and I understand, but that's how it is in this channel, and that's the value that I hope that I can provide. I want to be truthful and not just hype up everything just to get you to watch my videos, and hope that helps you. So thank you for watching, and if you did enjoy, please take a look at this video that I created earlier about my Discord channel, and you can join and we can talk about it and tell me your opinion about Netflix and other stocks and companies. And this is very helpful for everybody, because I can learn a few things as well. I mean, nobody knows everything, right? So thanks for watching again, and I'll see you soon, guys. Bye bye.